Something has quietly shifted over the last 24 months. Without a single news alert, without a congressional hearing, and without any formal public notice, the rules surrounding the $10,000 bank reporting law have been updated 5 separate times. And every one of those updates makes it more complicated, more consequential, and more confusing for ordinary American retirees to move their own money. This is not a warning about something that is coming. This is a warning about something that has already happened. It is happening right now. It is happening this week. It is happening in bank branches across all 50 states. And almost nobody over the age of 60 has been properly informed about any of it. I am going to walk you through 5 specific changes that have been rolled out between 2024 and 2026. Change number 1 means your withdrawal can now be delayed for a full 72 hours before you receive a single dollar of your own money, even if you have banked at the same branch for 40 years and have a completely legitimate reason for the transaction. Change number 2 means that a series of perfectly legal deposits under $10,000 done without any criminal intent can still trigger a federal structuring investigation carrying up to 5 years in prison. And the pattern detection software that flags these transactions was upgraded this year. Change number 3 pulls crypto transactions, Zelle transfers, Venmo payments, and Cash App sends into the same federal reporting pipeline that was originally designed to catch large cash movements. The reporting threshold on those digital payments is scheduled to drop to $600 this year. Change number 4 doubled the penalties on a form that contractors, attorneys, car dealers, and most businesses you spend significant money with are now required to file whenever you pay them in cash or cashier's checks above a certain threshold. And change number 5 is not a new rule at all. It is a number that has been frozen since 1970. And that frozen number is the reason everything else in this video has become so relevant so quickly. My name is Marcus Graves. I am an enrolled agent with over 20 years of experience representing taxpayers before the Internal Revenue Service. What I am going to cover today is not tax planning. It is practical financial awareness, because the $10,000 bank rule that most Americans learned about decades ago is not the same rule that exists today. If you try to move money the way your parents moved money in 1970, you can be flagged, frozen, reported, and in some cases have funds held, even if you have done absolutely nothing wrong. In the next 25 minutes, I am going to walk you through exactly what has changed, who it affects, what ordinary retirees are doing right now that is unintentionally triggering these rules, and most importantly, the 5 practical steps you can take this week to make sure your money moves when and how you need it to. But before I get to the 5 changes, I want to share the story of Martin and Carol, because their experience is a clear example of how these rules affect real people who have done everything right their entire lives. Martin is 71, Carol is 68. They live outside of Phoenix, Arizona. Martin spent 39 years as a regional manager for a paper distribution company. Carol was a registered nurse for 3 decades. They are not wealthy, they are comfortable. And last October, they decided to buy Carol's car in cash to avoid financing charges. They negotiated the price to $40,600 out the door. Martin drove to his branch the next morning to withdraw the money. He handed the teller his withdrawal slip. He sat down to wait. A few minutes later, a branch manager came out and asked Martin to step into a private office. The manager asked Martin why he needed $40,000 in cash. The manager asked whether anyone had instructed him to make this withdrawal. The manager asked whether he had received any recent phone calls or messages asking him to send money. The manager asked if he had met anyone new online. Martin, a retired 71-year-old with no cognitive impairment and a 40-year banking relationship, was being reviewed by his own bank over buying his wife a car. When Martin explained the situation, the manager told him the withdrawal would be delayed by 72 hours. Martin had to drive back to the dealership and ask them to hold the car for 3 days. When he finally received the funds, he assumed the matter was closed. It was not. Within 30 days, Martin received a letter informing him that a suspicious activity report had been filed on his withdrawal with the Financial Crimes Enforcement Network. That report now sits in a federal database for 5 years, cross-referenced against every future transaction Martin and Carol make. Martin did nothing wrong. He is a retired paper salesman who wanted to buy his wife a car. And what happened to him is happening to ordinary American retirees every single day. To understand why this is happening, you have to understand the number that has never been updated. The $10,000 bank reporting threshold was written into the Bank Secrecy Act of 1970. Not a typo, 1970. A gallon of gas cost 36 cents. The median price of a new home was $23,000. $10,000 in cash was more than most Americans earned in a full year of work. 55 years later, that threshold has never been adjusted for inflation. Not once. $10,000 in 1970, adjusted for cumulative inflation, is equivalent to roughly $81,000 today. If Congress had simply indexed that threshold the way they index Social Security benefits and income tax brackets, you would be able to withdraw $80,000 without triggering a single report. Instead, the threshold has stayed frozen while the normal, everyday transactions of a normal retiree have grown 3, 4, and 5 times larger in real dollar terms. A knee replacement, a kitchen renovation, a used car, a down payment contribution to a grandchild, an insurance payout, a lump sum pension rollover, all of these now routinely cross $10,000 many times per year. In 1970, the $10,000 rule primarily caught criminal activity. In 2026, it routinely catches retirees making completely normal financial decisions. That is the baseline. Now let me walk you through the 5 specific ways these rules have become more consequential in just the last 2 years. This is the change that happened to Martin and Carol, and it is the change most retirees have never heard of. In 2024, the Financial Crimes Enforcement Network issued updated guidance to banks on detecting and preventing elder financial exploitation. That guidance, combined with updated regulation best interest rules from the Securities and Exchange Commission, gave banks both the authority and, in many cases, the obligation to delay withdrawals from senior accounts for up to 72 hours if the bank has a reasonable suspicion the customer may be experiencing financial exploitation. What counts as a reasonable suspicion? It is not a suspicious phone call. It is not a fraudulent email. It is a withdrawal pattern that deviates significantly from your historical norm. If you have spent the past 10 years withdrawing $300 a week and you walk in asking for $10,000, the bank's compliance software flags the transaction. It does not know the reason. It simply flags it, and a human review begins. That review can take anywhere from a few hours to a full 72-hour window. During that time, your money is not released. Regardless of whether a surgery is scheduled, a car is being held, or a contractor is waiting. More than 37 states have passed their own versions of senior financial protection laws that grant banks legal immunity when they delay transactions they believe may be connected to elder exploitation. That immunity removes any financial consequence for the bank if they delay incorrectly. A bank that delays your withdrawal and is wrong pays no penalty. A bank that releases funds to an actual fraudster faces significant legal exposure. The incentive runs entirely in one direction. Delay first, clarify later. One more detail worth knowing. If your bank delays your withdrawal under this guidance, they are not required to disclose that is what is happening. They may say there is a processing issue, a compliance review, or nothing at all, and you have no legal right to immediate access during that window. This is the most legally serious change because it carries potential federal prison time, and the rules have expanded in ways that now catch behavior many retirees consider straightforward money management. Under Title 31, United States Code Section 5324, it is a federal felony to structure deposits or withdrawals for the purpose of evading the $10,000 reporting requirement. The maximum penalty is 5 years in federal prison, forfeiture of the funds, and fines up to $250,000. Here is the part most people do not realize. The money does not have to come from anything illegal. It can be proceeds from a home sale, a distribution from an inherited retirement account, an insurance settlement, or your own pension. It does not matter. If the government can demonstrate that you intentionally broke transactions into amounts below $10,000 to avoid the reporting requirement, that is a federal crime. For many years, this rule was enforced primarily against patterns in the $9,000 to $9,900 range, where the intent was clear. If you deposited $9,500 9 days in a row, you were going to be investigated. But in 2024, the pattern detection algorithms that banks use to identify potential structuring were significantly upgraded. The threshold at which those algorithms now generate a flag has been lowered. Regular deposits of $7,000, $8,000, or $8,500, spaced in a way that could be interpreted as intentional avoidance, are now being flagged. That flag can lead to a suspicious activity report, which enters the same federal database, which can then lead to an IRS Criminal Investigation Division referral, and in some cases, a civil asset forfeiture action. The Institute for Justice, a public interest law firm, has documented numerous cases where Americans had bank accounts seized under structuring rules without ever being charged with a crime. A family grocery business on Long Island had $446,000 seized because owners made deposits just under $10,000 to stay within the on-premises cash limit of their insurance policy. A dairy farmer in Maryland lost his entire operating account. A convenience store operator in Iowa lost $32,000 overnight. None of these individuals were charged with a criminal offense. The funds were taken through civil forfeiture, which does not require a criminal conviction. The burden of proof falls on the account holder to demonstrate the funds were legitimate, not on the government to prove a crime occurred. For years, there was a practical distinction between traditional banking and peer-to-peer digital transfers. That distinction no longer exists. Beginning in tax year 2025, every major cryptocurrency exchange in the United States is required to file Form 1099-DA, reporting every customer transaction directly to the IRS. Any single crypto transaction of $10,000 or more is now subject to the same Bank Secrecy Act reporting that applies to cash at a bank. At the same time, the reporting thresholds for Zelle, Venmo, Cash App, and PayPal have been declining each year. In 2023, the threshold was $20,000. In 2024, it dropped to $5,000. In 2025, it dropped to $2,500. In 2026, it is scheduled to reach $600. That means when your church reimburses you $600 through Zelle for catering an event, when a neighbor sends you $700 for a kayak you sold, when a family member uses Cash App to cover your birthday dinner, any of that, individually or in combination, can now trigger a Form 1099-K that the IRS expects to see reflected on your tax return. And a Zelle transfer of $12,000 to a family member for a down payment goes into the same federal database as walking $12,000 in cash into a bank. Same report, same database, same 5-year retention period. Form 8300 is the report any business must file with the IRS when they receive more than $10,000 in cash, cashier's checks, or money orders from a single customer in a single transaction or a series of related transactions. This covers car dealers, attorneys, contractors, jewelers, real estate professionals, and under new guidance, crypto businesses and certain digital payment platforms. Electronic filing is now mandatory for nearly all businesses required to file. The per-filing penalty for late or inaccurate returns was raised to $290. The penalty for intentional disregard was raised to $3,640 per return. These penalties fall on the business receiving payment, which means every business you pay over $10,000 now has a strong incentive to file accurately and on time. When you pay a contractor $12,000 to repair your roof, that contractor files a Form 8300 that includes your name, social security number, address, and a description of the transaction. When you purchase a car for $15,000 in cash, the dealer files it. When you pay an attorney a $20,000 retainer by cashier's check, the attorney files it. These reports go directly to the IRS and into the same database tracking your bank transactions. There is one detail that catches people regularly. Related transactions are aggregated. If you pay a contractor $6,000 today and $6,000 next week for the same project, the IRS treats that as a single $12,000 transaction, and the contractor is still required to file. Retirees who break a payment into installments thinking they are simplifying things may inadvertently create the appearance of structuring without realizing it. This is not a new rule. It is the mathematical result of 55 years of a frozen threshold meeting the ordinary financial life of an American retiree in 2026. Consider what a normal retiree does in a normal year: a car purchase, a kitchen renovation, a medical expense not fully covered by insurance, a lump sum distribution from a late spouse's retirement account, proceeds from selling a second property, maturing savings bonds, a substantial gift to a grandchild, a mortgage payoff, an amended return refund from the IRS. Every single one of those transactions now routinely crosses $10,000, which means every single one now triggers a report, a potential delay, a review, or a filing that would not have applied to the same transaction in real dollar terms even 20 years ago. The average American retiree is now encountering federal reporting requirements 3, 4, 5, or more times per year, and most of them have no idea it is happening. Those are the 5 changes. Now, here is what you can do about them. Before any withdrawal, deposit, or transfer of $8,000 or more, call your branch manager directly. Explain what the transaction is for and ask them to note it in your account file in advance. When the transaction hits the compliance software, the note is already there. The 72-hour delay happens far less frequently when you have pre-notified. The report over $10,000 still gets filed automatically, but your money moves when you need it to. If you need to move $12,000, do not break it into 2 separate $6,000 transactions to keep each one under the threshold. Either move it as a single transaction, which triggers a routine report you will never see or feel in any practical way, or space payments out with a documented business reason that has nothing to do with the threshold amount. Breaking payments into smaller pieces is exactly the pattern the detection software is designed to catch. And because asset forfeiture under structuring is civil rather than criminal, the government does not need to prove a crime. You need to prove your intent was legitimate. Every reporting threshold in the Bank Secrecy Act was originally built around physical cash. Wire transfers run through a different system with different thresholds and far fewer false positive flags on senior accounts. If you are moving $50,000 to a car dealer, ask whether they accept a wire transfer. Most dealers prefer it. Some will offer a small discount because it eliminates their cash handling costs and their Form 8300 filing obligation. If you use one Venmo or Zelle account for personal reimbursements with family and also for occasional income such as selling items or occasional services, the aggregate total can easily cross the $600 threshold and trigger a Form 1099-K. Keeping a separate account for personal transfers and one for any transaction that resembles income can prevent the wrong total from being reported to the IRS and save significant time at tax season. For every transaction over $5,000, write down the date, the amount, the source of the funds, the recipient, and the purpose. A notebook works. A simple spreadsheet is better. The majority of structuring and forfeiture cases that caught innocent account holders came down to whether the individual could produce a contemporaneous record explaining why their transaction pattern looked the way it did. A clear, consistent record is your most practical defense. Now I want to share one bonus move because it is the most effective tool available to senior account holders and the least widely known. I call it the Senior Safe Banking Authorization. It is a formal written arrangement between you and your bank that establishes in advance the types of transactions consistent with your normal financial activity, identifies a trusted contact the bank can call before delaying any transaction, and pre-authorizes common transaction categories, car purchases, medical expenses, family gifts, home improvements, as pre-cleared under the bank's elder fraud review process. Most banks do not advertise this option. You have to ask for it directly, typically through the bank's senior customer services department or wealth management group. The form is straightforward. Once it is in place, the bank's compliance software reviews your transaction against your pre-authorized categories before triggering the standard 72-hour hold. A transaction that would have been delayed 3 days under the default process is typically released the same day. This is the protection Martin and Carol did not have when they tried to buy Carol's car. After going through that experience, they put the authorization in place. In the 12 months since, they have completed 4 additional large transactions without a single delay. Now I want to tell you about something my team put together specifically for the kind of person who watched this entire video. We have assembled everything I covered today, along with several additional topics, into a single comprehensive resource called the Senior USA Guide 2026 Retiree Protection Checklist. The checklist covers the 5 bank rule changes in this video, the 7 most commonly overlooked deductions that retirees miss every year, the 4 estate planning mistakes that cost the average American family over $100,000 in avoidable taxes, the 9 Social Security and Medicare timing decisions most people get wrong, and the complete step-by-step process for putting the Senior Safe Banking Authorization in place with every major American bank. It is 42 pages. It is completely free. It is not a teaser, and it is not a sales pitch. To receive the checklist, go to marcusgraves.com, enter your email address, and it will be in your inbox within a few minutes. And while we are on the subject of protecting your finances, if you are planning to file your own taxes this year, or if you are currently working with someone who charges more than your situation warrants, I want to mention TaxSlayer. TaxSlayer is the software I personally recommend to clients who are comfortable filing independently. It is priced lower than the major competitors most people are familiar with. It handles every situation a retiree is likely to face: Social Security income, pension distributions, required minimum distributions, capital gains, and the new 1099-K reporting requirements. It is also backed by a team of tax professionals you can actually reach by phone if you have questions. The link is in the description below. Using that link supports this channel at no additional cost to you. Let me close with the most important point in this entire video. The $10,000 bank rule is not getting simpler. It is not being made more senior-friendly. It is not being adjusted for inflation. It is getting broader, faster, and increasingly automated with every passing year. The retiree who does not learn these updated rules, who does not pre-notify their bank before large transactions, who does not keep documentation, and who does not put a senior safe banking authorization in place, is the retiree who will face a freeze, a flag, a report, or worse, at exactly the moment they need access to their own money most. This is not a prediction. It is what is already happening to tens of thousands of retirees every year, quietly, without news coverage, without congressional attention, without any organized advocacy. It is happening transaction by transaction, account by account, family by family. You now have the information. You have the protection steps. You have the checklist. The only thing remaining is to act on it before the next time you need to move a meaningful amount of your own money. If this video was useful to you, please hit the like button. That is what signals the algorithm to show this to other retirees who need this information. Subscribe if you have not already, because next week I am releasing a follow-up covering the 3 banks with the strongest senior account protection policies in the country, and 2 banks worth reconsidering if you are holding significant cash deposits. And if you know a friend, sibling, parent, or neighbor over the age of 60 who moves real money through a bank account, send them this video directly. The rules have changed. Most people have not been told. You can be the person who tells them.